I want to bring in Neil Dutta, who's joining us to talk the economy and the number. He's the head of U.S. economics at Renaissance Macro. Neil, great to have you on the phone this morning. Obviously, the big implication here, let's cut to the chase. Does it change anything for the likelihood of the Fed in July, Neil?
Oliver, I don't think so. If you look at where the markets are trading, I mean, the market was basically fully priced for a July cut before, and it looks like it's still fully priced for one right now. I think most of the action is just sort of shifting expectations around 3 cuts for this year, so that looks like it's come down a bit more, and that may be why you're seeing some steepening in the sort of very front end of the curve here. But I think the die's cast, right? I mean, it was really we needed a blockbuster type number, and this was a good number, no doubt. But I think the Fed has enough sort of rationale at this point to ease if they wanted to. You look at the unemployment rate; it's ticked up. Wage growth has flattened out. So that would argue maybe that there's some residual slack in the jobs market. We saw an increase in the participation rate. And the global economy still remains quite sluggish. And, there's still an uncertainty overhang with respect to issues around trade. So, this was never really about the economy. I mean, if you look at just the June FOMC statement and you just read it, they were never really that bearish on the economy.
Right.
And they still opened the door to a rate cut. So, I think importantly is that following that meeting, they haven't really done anything to sort of shift market expectations, which I think there's some signal there, right? The fact that they haven't said anything, big policymakers, maybe suggests at the margin that they're sort of in agreement with it. We'll see what Powell says next week. I mean, he's delivering a testimony before the House Financial Services Committee. I think that's on Wednesday, so a few days from now. That provides an opportunity, but historically, those are not the forums to make big changes. So I don't, as I say, the die's been cast. The train has already been put in motion, and I think if you look at what the bond market is saying, Oliver, it feels like they can cut a couple of times, the economy stabilizes, and that's it. This isn't about going back to the zero lower bound or anything like that. And, you do hear people, once the Fed starts cutting, they're just going to keep on doing it. It doesn't really feel like that's what's going to happen because the economy is okay. And this is mostly about, uncertainties and kind of taking out some protection against those uncertainties.
Neil, for you, does the analysis of a July cut begin and end with the market's expectations of the cut? Because obviously there's a history here where the Fed follows the market at 100%. Yeah, I mean, there is sort of that old adage, right, that the Fed decides when to hike and the market decides when to cut. So, I mean, I think that's, but it's important to understand what the market has been pricing in. I think this is the point the Fed is making. The market has priced in downside risks going up, right? And that's why rates have come in the way they have. And so that's what this is about. And the Fed is sort of acknowledging that those are significant risks. I agree with those that say that their communications process has been kind of haphazard. I mean, if you look at the reasons, right, that they've been talking about cutting, you could have been making that case last year, right? I mean, weak global growth, inflation below our target. Right.
So, I think this is a little bit about sort of taking back December, which I think in hindsight was probably a small policy mistake, and then compensating a little bit for, the fact that business sentiment has come in, quite substantially given the sort of issues around trade. And remember, even with the trade issue, again, the damage has already been done. I mean, just because we've, the Trump administration has struck a truce with China, it doesn't mean the effective tariff rate this year is lower than it was last year. It's still higher, right? So tariffs are still kind of weighing on in particular the industrial sector here in the States.
Neil, this morning we see a pretty quick response in some of the moves over the last 2 weeks that seem to be a reflection of the market's expectations for at least one cut, if not more. Obviously, Bullard has drawn down the market's expectations for a double cut in July, but some of those moves are reversing this morning a little bit. You got a pretty sizable move in gold to the downside. You got a pretty sizable move in
the dollar to the upside. Can the Fed do that single cut and then kind of get out of its own way? Or is that kind of the fine line they need to thread here? Because if they are at all worried about, kind of overstoking the economy in an attempt to hit their inflation number, I mean, we got another sign today that apparently there's quite a bit of slack in the employment market, or what?
Yeah, I mean, I don't think that. I mean, as I said, I mean, the inflation story has been persistent, chronic. I mean, when has the Fed ever, hit core inflation on a 2% basis? And they're going through this review of their policy strategy, and one potential option is sort of an average inflation target where they kind of shoot for 2% over the course of the business cycle. Well, if they're thinking about that, then that calls for looser policy, all else equal. And the inflation data from the labor market, doesn't really seem to corroborate inflation kind of surging beyond their target. I mean, average hourly earnings have, if anything, been flattening out over the last few months. So that would suggest that there's still some residual slack in the labor market. And if that's the case, then they can get away with cutting, right? I mean, there's no threat of overheating right now. You have inflation expectations basically at levels, at least in household surveys, that we haven't seen ever, right? I mean, if you look at UMISH, for example, 5 to 10 year, that's like at, 2.3%? I mean, the cycle lows. Actual core inflation is, 1.5, 1.6%, so several tenths of a percentage point below their target. It has rarely hit 2% on a sustained basis. You have weak growth overseas, and that's putting upward pressure on the dollar, which is disinflationary. So, I think, this is if you're a monetary type economist, you think the central bank has some control over the inflation dynamics, and I think it would call for easing.
Neil, you guys had an interesting chart on the point of unemployment I want to bring up real quick. Just the idea that there's a little bit of a difference between the levels of unemployment compared to history versus the Conference Board's labor differential. And I thought it was kind of interesting, your guys' implication from the chart, basically that maybe there's still more employment gains to come. Can you kind of walk me through? Because I think a lot of people are surprised to see that big of a top line number today.
Yeah, I mean, that's what you have to ask yourself, is that if we have such low unemployment, why do we keep generating these jobs numbers that are consistent with, growth in the labor force of much stronger than what you would think to keep the unemployment rate flat, right? So, when you look at things like primate labor force participation, that's still below where it was in, 07. A lot of the increase in participation has been from women, not really men. So maybe there's something there. People talk about opioids and things like that. But 20 to 24-year-olds also, their participation rates are much lower than they were in 07. So you basically had a lot of people kind of going back to school, retooling. They had nothing else to do because the job market was so weak. That could be changing. So I think there's plenty of sort of potential workers out there. And I think that the fact that, that wage growth isn't shooting up, suggests that those people, could probably come into the workforce, right? I mean, and, otherwise how else would they be able to exert some downward pressure on the wages of those that are already working?
Sure. Neil, obviously the conversation is going to continue about July as we get more numbers in, even with the market, pricing this in as a done deal, or the die is cast, as you put it. The last thing I want to get your take on is, what do you see as being the most damning evidence of characterizing the December hike as a mistake? In a hypothetical, let's say the market didn't drop the way it did at the end of last year. I know it's kind of an unfair game to play, but what, apart from that sort of financial tightening through market action, what outside of that says that it was a mistake? If the manufacturing weakness is kind of being imported from abroad, and the consumer sentiment remains strong, and the services data remains strong, and the employment data remains strong, where's the mistake showing up in the data?
Well, I think an important thing to kind of think about is policy set to the level of activity in the economy, or is policy set to the momentum in the economy? And I think, historically, I've sort of thought about it as levels, right? I mean, the unemployment rate is low, and for example, if you think about a Taylor rule, right? I mean, you're not putting in the change in jobs growth into a Taylor rule, right? You're putting in the unemployment rate. So it's a level of activity indicator versus a momentum type indicator. But I think to answer your question, I mean, it's the momentum in the economy that suggests that the December hike was a mistake, not just in the U.S., but also to a greater extent even globally. All these sort of survey type indicators, IFO index, German factory orders, I mean, they've all come off the boil. I mean, remember there was this whole thing about, it's the auto regulations in Germany and the water levels in the river that's kind of keeping the manufacturing numbers in Germany weak. Well, all those things have kind of gone away, and the numbers still suck. So, maybe they kind of misread what was going on globally, but Europe is obviously a very large, open economy, and it's collateral damage, I think, to some extent in what's going on between the U.S. and China. We're basically looking at numbers in Europe that haven't been this weak since the European sovereign debt crisis. I mean, that wasn't exactly a time the Fed was thinking about hiking, right? I mean, they were thinking about doing things to kind of, put guardrails up around the U.S. economy, meaning easing to offset the weakness from Europe. So, I think it's the global numbers that have been weak, but also domestically. I mean, you saw pretty weak domestic demand growth in the U.S. in the first quarter, right? So, there's some of that as well. Obviously, the jobs numbers have slowed. We've seen business sentiment in the U.S. weaken. I mean, ISM was better than expected, but still, generally has been pointing to more sluggish growth.
Yeah.
So, I think that the economy is still operating at a very strong level, right? I mean, we're still talking about GDP growth expanding. We're talking about the unemployment rate being low. But it's that pace of improvement that I think is why we're talking about cuts now. And the pace of improvement is slow. I mean, obviously, for the level of activity to keep going up, the pace of improvement has to maintain a certain kind of rate. And if that's not, and if we're not getting that, then the level of activity ultimately will come in. So that's sort of how I'm thinking about it, if that makes sense.
Neil, definitely really good stuff here. Obviously, a really important morning, but the die is cast. I like it, Neil. Really good stuff. Good work as always. We got to run opening bell here. Neil Dutta, head of U.S. economics at Renaissance Macro.